All right. It looks like we got quite a few people in here already. We got Sid, who is our awesome host today, ready to go. Sid, are you ready to rock and roll?
Absolutely. Sorry for the delay. Been just trying to, uh, as usual, the ID issue. No, I don't want to blame that. But thanks for joining. Brian, we can start. I think the recording is in play.
Yep, you're ready to go.
Awesome. Thanks everybody to joining this evening. I know it's first week of the year, and I want to say everybody's pretty much catching up with work. So we truly appreciate the time that you are putting in. It's 5 p.m. today. Um, Without any break, let's move on. If For those of you who don't know me, my name is Sid Shamim. I am the founding principal for Headway Properties, Headway Capital. Brian is investor relations director. I mean, we're lucky to have Brian in our as part of our team. On your screen, you will see the phone number. This is our phone number if you are looking to get the slides. Feel free to text on this number. Brian, they can also call on this number, right? People can call
Correct.
on this number too. Yeah. All right, cool. Just as a disclaimer, this is a webinar only for education purposes. If you consider anything to be an investment offering, make sure to talk to your CPA, your investment advisor, or your lawyer, right? So just making sure we're getting past that. Awesome. So just a little bit about ourselves. For those of you who don't know me, I just introduced myself, Sid Shami. I'm the founding principal. Anam Omar is, Dr. Omar is my wife. She is also a director for business development. Her main job is being a GI gastroenterologist, but she also helps with uh, you know all kind of business that we've been doing on investor relations side. Same for Brian LaFaro, he's our investor relations director. If you are one of our investor and you have a question or any of that of any kind, Brian is the person who's going to answer that. Umar Nakwi is also our CFO. Our goal as the Headway is to continue our growth through investing in real estate, right? So um, when I created this, started the journey, we our goal was to invest our own capital, and this goal stays the same today, right? So any investment that we have today, right now, is the we are the biggest investor in our projects. So that's our philosophy at Headway here. Let's see, next slide, Brian. Just to let you know on the where we stand in terms of the size for Headway, we own just about 540 million assets under management. This about about 3,300 apartments that we either own or manage or are partners in. By partner we mean general partners, so that we are controlling the decision and on operations. We own assets throughout Texas and in Arizona. Historically, our thesis has been to produce at least 25%, 30% average annual return. In or in other words, you can also we only look for assets that we can double our investor equity within 3 to 5 years. So this has been a very a key component for us to stay focused on. Currently, we have almost 430 active passive investors, and I say active passive investors means these are the investors who are actively invested in our projects, but they are passive, right? So they don't do it. They don't have any role on operations. Next slide, Mark. This is one of the very important slides. I mean, we always have a mentality that we are an operating company first before we are a private equity firm, right? What it means by that is we believe in execution and operations, um, because we have seen growth by raising capital is just not the solution, right? So when we raise capital, we have to go and perform on those projects to produce those results, right? And how do we do that? How do we get there? We internally we stay focused on what we pick, right? Whatever projects we pick, we make sure that this is a purposeful um, operation, purposeful project, and going forward, we stay with a disciplined and consistent approach. What it means by that is, even if we have a small project in middle of nowhere, we know that the results can only be generated when we are disciplined and when we are consistent, right? That's our flywheel, our core competency in that headway. So today, we're going to talk about something really interesting. We're going to talk about market volatility and how this is going to impact distressed real estate, right? The Just to give a little bit of background, if you guys are not in Houston, right, then you basically know the first incident of market being shifted in any way is COVID, right? But if you're from Houston, then you also know right before COVID, Harvey happened, right? Harvey is a biggest storm, came in 2017, and this was a time when 2017, 2018 time, where instead of pricing for the projects go down, they actually went up. Right after that, COVID-19, which is right in the middle of 2020, March time, that was the first market correction. So until that point, real estate market was on the peak. There were people who were predicting that COVID time will be the time when market will correct. That assumption proven wrong, right? So 2019 impact on multifamily was short-lived. What happened was that people were not paying rent, but at the same time, government stepped in, right, and they start paying rent for those people. From that perspective, COVID-19 impact on multifamily was hard, but it also recovered pretty fast. So instead of pricing going down, we all saw that right after COVID, prices continued to soar. One of the biggest reasons that this happened was because the interest rate was keep going down, right? So at the time, the federal government was keeping the interest rate super low. Okay? We have seen right from 2020, 2021, 2022 was the highest time that people were purchasing real estate. And then right in the middle of end of 2021, middle of 2022, I want to say first or second quarter of 2022 when we start feeling the interest rate is going to increase, right? That's when this right after 2020, this whole market for multifamily, at least of commercial real estate, was in a wave, right? I call it a wave because it went up for higher pricing, and then people were just buying. Pretty much anybody that we knew were buying commercial real estate to a point that for one project there were 40 to 50 bids, and it was never in the history, right? So that's something we've seen that in the past, right? Next slide, Mike. So what happened at the right in 2020, your interest rate started picking up, right? And we have seen in all of 2020 and 2023, the interest rate was just on the rise. In the middle, in the end part, in the second, third, and fourth quarter of 2021 and all of 2022, the darling of all debt was Freddie Floater, right? And I call it darling because Freddie Floater was the most famous loan product that was available outside in the market. It was so much, it was so much dominant in the market that the closest fixed rate that was available for in the market for commercial real estate was at least 200 basis point higher, right? So we even bought one property in the middle of late 2021 and a floating rate, which was at least 250 basis point. So to give an example, the prevailing rate at that point in late 2021 was somewhere around 2.5, 2.6, versus the fixed rate, and the top was somewhere around 5.5, or 5.25. So it was a big difference, right? So anybody who was purchasing those property at the time was simply going for that option, the floating rate option. Why? Because number one, the business sense was just dictating to go for lower rate, and number two, which was the most important thing, was that lenders were selling something called interest rate cap, right? Which basically means you go buy protection in an event. If the interest rate goes up, you will go buy protection where you will not pay over a certain amount, right? And that interest rate protection, which sometimes it's called strike rate, sometimes you probably have heard protection, sometimes it's interest rate cap. That was super cheap. So in other words, if you're buying an interest rate debt, like if you're getting a loan from the for the property, your interest rate is floating, which means every year, every month it might change. Then you have to buy a protection so that it don't go above a certain level. In short, in summary, lenders were selling those interest rate caps for dirt cheap value, right? We're talking about maybe $50,000 for 3 years of protection, right? The same protection today is somewhere about $2 million, right? So properties that were bought in that time are now either struggling through execution of business plan, or they are struggling through rents not being catching up with expenses, so inflation, or they're simply not being able to catch up with their payments. Now, there are different levels of how people are struggling, or how properties are struggling, but I would, in simple words, what I will tell you, operators who were not able to implement their business plan, so either they were struggling with not increasing rent, or not being able to increase the occupancy, or not being able to execute the business plan, which means completing the all exterior and interior renovation, maybe unit turns. Those are the people who are really struggling now, because on top of it, since they have no money coming in and no higher money coming in, they're also paying 3 to 4 times more interest rate. Now, the one that are not so much in trouble are the ones who actually do get those interest rates, those rents, higher rents. They have executed the business plan. Their income is coming. Their income is higher. Their expense are meeting for the income, but they still have to pay the higher interest rate, but also the future purchase of escrow, right? So in other words, I want to keep it simple. I don't want to use too many jargons, but in simple words, they are required to not only pay higher interest, but also to start saving money to buy future protection, right? So remember when I said initially they were selling the protection for 50,000 for 2 years. Now they're selling it for $2 million. So somebody has to bring that money, right? In my opinion, that is the second set of operators who did bought the protection, did execute the business plan, have the higher rent, have the NOI increased, but still getting impacted by the higher interest rate. They are still in a better position because they can still try to save the asset either by bringing more cash from outside, or by putting money on the out of their own pocket, or even going to the investors back to the investors and increasing the cash flow. So in short, there's a variety of reasons why a property could struggle, right? The worst reason that property could struggle is that if an operator is unable to execute the business plan and also did not have any protection bought at the time of purchase. Those are the deals that we are looking in going in 2024. These are the ones who are going to struggle. We are already seeing evidence of foreclosures, market capital, and majority of the bigger market debt companies or brokers, I would say, these guys are already predicting about over 400 billion of real estate loan coming due that are their DSCR is lower than 1%. So again, I don't want to use too many jargons right now, but in other words, majority of real estate is going to be in distress in 2024, right? There'll be an influx of huge number of projects that lender will be taking back, and they'll be floating in the market to sell it off, right? Next slide, right? So speaking of that, right, that basically gives you a clear idea where we're heading, right? Why this real estate distress is coming, right? Owners may be performing, and they still end up selling it for sure, right? I personally have seen examples where our fellow operators were doing a good job, but they just could not maintain the higher interest rate or a higher protection purchase, and they end up selling the property for a loss. Do we think that those kind of projects are already in the market? Right now, the answer is that they are mostly in the in lender negotiation, right? So what happens is, like I said, there's 400 billion of commercial real estate is going to be distressed next year. Some portion of it is also in Texas, right? There, and why we are talking about Texas, because Texas will have the majority of those, right? Unfortunately. Does it mean that real estate in general will impact from this recession? In my opinion, the answer is no. But those who are unable to meet their debt requirement, their DSCR requirement, or their lender requirement, they will be the one who will be hitting the market in quarter 1, quarter 2, and maybe only quarter 3. But there's an interesting twist here as well. Fed just recently announced that they are, or the federal government recently announced that they're going to drop the interest rate by 75 basis points, or in other words, they will cut the interest rate by, I want to say, about 10 to 20%. That is a time which I'm seeing right now, which I believe will give some breathing space to the operators who are not as bad of a position, right? People who have executed their business plan, but they're only getting crushed by the higher interest rate, while that interest rate will going to come down. So these operators, this operator will have a high probability of being saved going in 2024, right? So that is a big adjustment, and I say adjustment because if these operators are able to save their deals in 2024, then what we are seeing right now is that big 400 billion of transactions that are struggling with the lender requirement. There's something called DSCR, debt coverage ratio. That number has to be at a certain level. Majority of these transactions are not meeting the DSCR, which means either they will come on market for sale, or if the interest rate comes down, then the good operator will be able to save that deal either by refinancing it into a different loan or by paying it out and getting a little breathing room. So the key over here is 2024 is still kind of unknown, because who will be saved and who will not be saved will really be a matter of first 3 quarters. Last but not least, I think I'll give you an example. I personally have looked into, was approached by some of the groups outside who are already gearing up to buy distressed assets. Right. I've seen one transaction that went right in front of me for a 50% discount. Right. If, Interestingly, multifamily is still the asset class that's holding its strength even in the downturn, right? That um, that strength comes purely for its intrinsic fundamental of people need to live somewhere, right? The federal government, the debt market, the equity market, private investors like you and me, we still believe in that project. We still believe in that asset class. So even though the correction will come, but that correction will be for a very short period of time, right? So if you guys are one of those people who are waiting for that moment to, uh, have the money to buy, you gotta get in touch with the right operator. Not every operator or not every buyer will be able to buy those kind of deals, right? That's something I want to make sure that I'm saying this. People who are buying those kind of deals are people with big pockets, right? Or people who have the good connections, or they have the right reputation in the market, or they're the one who lenders know that these guys are the right operator in the town. So those are the one who will get the first bite, right? People who are extremely wealthy, but they don't have the reputation or a track record, they won't be able to avail this opportunity. Next slide, right? So again, I think we've covered majority of those, right? So it's time to buy, right? Time to buy for upside. The when you buy any business, the philosophy of buying a business is to buy for cash flow. That's still true, right? If there's no cash flow, we don't go into any transaction where we know that there is no cash flow. That's just very plain and simple for us. But this in this year of 2024, we strongly think that majority of the profit will be made at the time of purchase, right? You will see some of the newbie and some of the New York and California money will be chasing some of these deals, and they will be looking at operators like us who has the local knowledge, right? So when I say New York and California money, basically investors from those states. What they do is they try to partner up with guys like us or other groups who have the strength or reputation in the market. Even Brian gets called all the time, and people are just looking to invest in Texas, right? Why? Because of two major reasons. They know that they will make the money at the time of purchase, right? So it's a strong saying, it's a good saying that you make your profit when you buy. This is the time to buy, right? For those distressed assets. Look for the operators who are up for the challenge. I can tell you there are in 2023, when the interest rate was spiking, you will see a bunch of operators in 2024. They will just simply hand over the keys to lenders. This is one strategy. I mean, I don't particularly feel if it's a right or wrong strategy, because they try to do everything they could, but they just cannot keep funding the high interest rate, or they cannot go back to their investors because it's a lot of work. It's 3 times more work than anybody can imagine, right? So that part is super important. Like looking for the right operator, talking to the right people who are who are in the market doing the things, and more importantly being transparent, right? We have had transactions where we were being in that situation. but we were being super upfront and transparent with our partners, and we went back to them and explained them with clear transparency that where we are right now, and we are able to get back on track. Right, we are in the process of getting back on track. So, I to summarize what I'll say in the next slide is Brian, next slide. So to summarize what we are looking in this market right now is multifamily is still going to be the winner in the recession. Multifamily will still be the only asset class that will gain some kind of momentum from, or some kind of support or momentum from the government. And 2024 will have maybe the first 3 quarters will have the buying opportunity. Now, there is a school of thought that is talking about majority of the property will come at the end of the year. I believe that's only the case where these operators are not able to save their assets in the first, in this quarter or next quarter, right? So I still think that interest rates are coming down. Majority of these operators will be able to save their assets by either refinancing it or by being able to afford the payments. But the first 3 quarters or second quarter, third quarter of 2024 will be a very short opportunity to purchase. We are already seeing if you guys are following the market, you probably have seen this is the year which has the record lowest transaction in commercial real estate market. So that being said, I think the opportunity or the sky is very clear, right? If you are one of those people who are sitting on sidelines for several years and you always knew that, hey, I'm just gonna come out when everything is crashing down, right? Well, the good news and bad news, I don't think that's going to be true all the way, but there'll be a short window of opportunity just because, like I explained, those interest rates are coming down and people who are out of money are going to be able to save, but people who are giving up early on won't be able to save. Next slide, Mark. Awesome. So with that, I think this is the part where we just point out a few items on the question and answers. Go ahead and write your question and answers in the Q&A box. We will go ahead and answer any questions. What other opportunities do we have right now? This is a slide we just want to go over right now. We are really focusing on our operations right now. But we are also being receptive and open to look into any distressed assets, especially if this asset is nearby our properties, right? So as you guys know, we or some of you may not know, but we own majority of our assets in Texas area and Phoenix area. Houston is our home right now. We operate from Houston. So we are actively looking at any distressed assets that might hit the market. We have been, but that's not really, if it's not really a distressed asset, we're not getting excited about it, right? So we're focusing on our current operations. The other part that we have right now is real estate income fund. So we are paying out about 8%. On 8% current, which basically means for a minimum of over 100,000 of investment, you get paid 8% every quarter on a monthly 8% annual on a monthly payments, and that is purely used for loans that are made for renovation projects, right? We time to time we do partner with a group that work with us on the car washes. That car wash this year, last year, well, that's 2024. Last year, we closed a car wash portfolio is doing very well right now. I think it's producing about 7% current and projected to do 2x multiple on the equity. We believe we are very in close relationship with this partner, and they're doing a great job. Our winner right now in this market, where you know, majority of the things are uncertain, is the real estate income fund, right? Uh, it's still producing the biggest 8% return, and unlike any other products in the out there, there's no long-term commitment, right? So within 3 months notice, you can withdraw your money, you can move your money away from the income fund. So that's one of the most famous product right now. Next slide, Ryan. If you are somebody who is interested in learning more, we do a weekly webinar. Once a month, I come on and pick up a topic like this. Brian is one of our great speaker. He comes with some of the topics that are purely education based. It's not a sales pitch. And then 2 other weeks, my wife, Dr. Mar, she does healthcare driven focused education seminars. You want to, if you want to be a part of it, you have to join, right? So go to our website and try to register. That way you get those updates. We also, if you are in Houston, we also do once a month property tour, right? So again, it's not a sales event. What we do is we try to do. I personally go and inspect and audit my properties once a month anyway, and I come up with an idea, just like, okay, why not just bring other people as well? Because if the property is in best condition, I want to see it and I want to show the world to see it as well, right? And that's the best education experience we can have as an in-person property event. Next slide, Brian. This is the QR code. Go ahead and take a picture or scan it from your phone camera. That will take directly to your take you directly to a registration page, something that you can just get registered, and you will get all kind of details in there. I think we are done, Brian. I think the next slide would be just a Q&A. Yeah, go back. Sorry guys, my control is not working today. That's why I'm Brian is investing time with me. Thanks, Brian, for your patience. The capital income, this is the real estate income fund that we're talking about. Again, it produces 8%. This is a very simple, you can think of it as a renovation fund or hard money fund. You can scan this QR code. It will directly take you to the document, and you can, if you have any interest, you can schedule a call with me or Brian, and we can, take you through that. I see some Q&A. Daryl Wilvox, have you ever had a capital call for your existing investors? Yes, I just explained that in the webinar that we had this scenario. But we were on the point where we were our average rent increase on our asset was about 15 to 20%, and I'm telling you on an average, that is the highest rent increase that we can ever have, right? One of the questions we have is, what is the total investment size that you guys usually take for income fund? Like I said, it's 100,000 minimum to get to the 8%. One of the questions, do you have any current investments where your growing interest rate cap escrow is straining the profitability of investment, and if so, what is you doing about that? Yep. So the project that we bought for floating rate, to give you an idea, if this the answer is yes, right? So, and I'm explaining you what happened, what is the impact that we had. The insurance, the higher interest rate, if we go back to our original interest rate, we would be producing at least 12% cash on cash on those projects that we are paying extra to the lender. Now, what we were able to do is we were able to turn around and go back to our partners and show them our NOI performance, that we are at, we have executed all of our business plan. We are now at a point where we can simply go ahead and take our property out of the floating rate and go into the fixed rate. So our goal is to buy, as soon as we change our loan, we'll go back to our cash flow. Right, and it's a very strong strong performance in this market right now. Have gone full cycles? Yes, we have gone full cycles. Somebody asked that if you have gone full cycles in your investments. Yes, we have. The last one we did was, I think it was 2.3x of the equity. We have the Brian can also share the performance track. If you're interested, set up a call and he'll follow up with that. How are you? There's one other question. How are you handling insurance as it's greatly affect net income insurance pool? Good question, Judy. Yes, what we are doing, we actually spend the whole year this year, last year, I keep saying this year, last year, 2023, is to work on our insurance. And what we end up doing is we are accumulating all of our insurance into one umbrella called master policy. Insurance that we were hit high, we actually was able to bring the insurance down on certain properties just by accumulating into a portfolio, right? So even there's a scenario where I'm looking at to expand our network with like-minded operators and bring their properties under our portfolio as well to bring some more savings. So we work on our insurance very closely. That's part of our job, really. One other question. Do you have any open, if I'm reading it right, do you have any open offerings right now? No, not at this point. What we have open is the short-term investment, which is the 8% income fund. We call it short-term because it's super liquid, which means within 3 months of notice, you can pull your money back. One other question, what do you think Q1 or Q2 will look like for 2024 for apartments? If I'm understanding the question right, I think you're talking about impact of recession or impact of market turbulence. Like I mentioned, I think the first, second quarter, or third quarter will be the short window of time that all these distressed assets will be in the market. I also think that it will be flooded with buying opportunities, and people who don't want to sell will have to wait, right? And we are one of those, right? We are working extremely hard to sell our assets only for the profit that we have projected to our partners, right? So we're not gonna sell anything lower than what we not anticipated, as long as we can, right? So we will not be in those scenarios that I can guarantee you. But at the same time, apartment in general is a most resilient asset class, right? You can pretty much go into any brokerage, any big real estate firm and read their article. Any data you will pull out. Me and Brian, this is our day job. We look at data at least once a week in detail. And trust me, if I put all of this data on this slide, majority of you will not come back again because this is just so dry. It's just not for everybody, right? Every single data point that you will pick up for apartments, you will see apartments have always been the most resilient asset class. You might hear a bunch of things about land investment, about office investment. Office has been, I want to say, down the drain right now. The way it's been vacant, right? People taking office buildings and converting into storages and converting into apartment complexes, right? So you will never hear anything like this on apartments. You will see um, uh, self-storages or flex spaces and things of that nature. They are the frontliner for economy, right? So they are the one who get impacted or got hit by the recession first. Apartment always come in the end, right? So it's always um, apartment is still where your rent versus buying capacity for the majority of the population is still not there, right? The need of apartment will still be there. There will be some cycles like this, like interest rate uh, um, spiked or things of that nature. That will always happen. But again, these are majority of the times these are uh, the asset class that will survive, right? Um, Again, look, I don't want to bore you with the dry data, but that's the historical track for apartments. One other question: are you looking for any other markets for multifamily or strictly in Houston, Texas? The answer is not really. I think our focus has been just making sure that we are uh, operating in the profitable manner. If we are looking for anything, we are potentially looking into Texas in general, maybe Houston. But again, that's really depending on what kind of distress are we looking at. Right. Another question coming here: would you consider more reliable source of such data? What do you consider more reliable source of such data? Um, the best way to go about it is to go to websites. Um, we basically pull data from Marcus Millichap. That's one of the sources. CBRE is one of the sources. Newmark is one of the sources. These are all big brokerage houses. They are the one. Um, Berkadia is the one. JLL is the one. Cushman Wakefield is the one. So there are 5 to 10 big. Colliers is the one that we work very closely with all of these groups. You can go to their website and you can pretty much download their quarterly report. And these are the groups who pretty much do 80% of all transactions, right? These are that data will tell you pretty much the whole history of all asset classes performance. One other question, can you explain a little bit more about the fund? I believe you're talking about the income fund. Yeah, Brian, can you go back on the income fund slide? Brian, do you want to pitch in on this income fund?
I think you did a good job highlighting it. So it's just a short-term income fund. So if anybody has any extra capital and they like liquidity, very similar to say a short-term CD where you can put your money in and have access to it right after. The tie-up period for this investment opportunity is very short. So once your capital is in, all you got to do is give us a notification, and we usually get your money back in, we say 90 days or less according to the PPM, but it's usually much faster than that. So if you've got, 50, 75, or $100,000 and you want it to generate some passive income for you, it doesn't have any upside or like a traditional investment. It's just a short-term income fund. It's a great place to park your money, especially while you're looking for other investment opportunities and you want to maintain that liquidity. So a lot of our investors that come into this fund, they're looking for multifamily, they're looking for car washes, they're looking for other equity plays, but they can't find any, or they're just waiting patiently. And rather than keeping their money in the savings account, they want to put it in somewhere that's going to earn a little bit of cash flow for them. So they decide to put it in this fund, and $100,000 or more will get you that 8% return.
Yeah, yeah. And just to in kind of more simplified way to think about it is if you have a CD account will pay you maybe 4.5%, 5%, maybe 5.5 in the best case scenario, but they will require you to lock the money for at least 12 months, right? When we are coming up with this offering, we have looked into all other options. This is a best product that we could find that we can partner up with a great operator. That 8% with 3 months or less of the liquidity is something that we were not able to find any product like this in the market, right? People are claiming about 10% return, but they want the money to be locked for 2 years. I personally have invested in 12% return, but they want the money to be locked for about 2 years, right? So these are the cases where um, our product is right in the middle. It has the most, is the highest possible return, but at the same time has the lowest amount of lock periods. It really doesn't have any lock periods. So think of it as a your CD or your saving account on steroids, right? You don't have a long-term commitment and you get almost a double return on those items. One other question come in here. How many years has Headway been doing syndicated investments? That's a good question. At least 7 years, Dell. And you also asked about the question of how many full cycles. We have done, I want to say, at least 7 or 8 full cycles. Overall, we own about 43 interests and projects, 43 projects. Majority of them are the exits in Phoenix area. We were scheduled to exit quite a bit of properties in 2023, in 2022. Market didn't allow it, and we just, we were able to hold the operations, and then that's why we hold it. So to answer questions, about 7 years or more in the syndication, in I want to say 7 or 8, and I don't have the exact count in mind, but 8 exits so far on our projects. I guess that's all we have. Good to see a bunch of people, several familiar names. Thanks for joining. Truly appreciate your time in this hour. If there are no other questions, I would thanks everybody, and hopefully we'll see you